Hello, I'm Ruben Alcoba. I am a licensed Florida attorney, and today I will be presenting an overview first on what self-employment tax is, who it is applied to, and then I shall finish this presentation by comparing how self-employment tax affects S corporations as opposed to limited liability companies. Self-employment is a tax that is governed by Section 1401 of the Internal Revenue Code. It is a tax that is imposed on individuals who derive income from carrying on a trade or business as either a sole proprietor or a partner in a partnership. To understand how self-employment affects a sole proprietorship, we have to understand that a sole proprietorship is what it is. It is a simple entity that has only one owner who owns all of the assets of the business and is entitled to all of its profits. The owner's business income and profits derived from the business are reported in the owner's personal tax return. There are no documents needed to form a sole proprietorship, nor does the owner have to observe any formalities in operating its business. In short, a sole proprietorship is not a separate entity from its owner. The disadvantage of a sole proprietorship is that the owner will be responsible for all the debts, obligations, liabilities, torts, or acts committed by his company, employees, or agents during the course of his business. A sole proprietorship must pay self-employment tax on a business profits. Yet he may be able to deduct insurance premiums paid for accidents and health insurance for the sole proprietorship and his spouse and dependents. A sole proprietor can form a single-member LLC in most states. The advantage of forming an LLC is that it should absolve the owner member from being liable in his capacity as a member of the obligations of the LLC. To form the LLC, the sole proprietor will have to file articles of organization with states that permit them in order to be able to rely on the protection. A single-member LLC will be taxed as a sole proprietorship unless its member elects to be taxed as a corporation. The owner of the single-member LLC, if his LLC does not choose to be taxed as a corporation, shall have to pay self-employment tax. The benefit of choosing to be an LLC is that the LLC's liability will be covered in accordance to state limited liability law, company laws. A single-member LLC is a disregarded entity. What does this mean? That the service will not consider it to be a separate entity from its owner. Yet, the service will view the LLC as a separate entity when it comes to paying employment tax liability. A partnership is an entity that exists when two or more owners jointly engage in a business for profits. There are various forms of partnerships. Some are registered with governmental state bodies, and they will be afforded protection under individual partnership laws. Otherwise, the default general partnership rules of each state shall apply. The service, for purposes of self-employment tax, draws a distinction between a general partner and a limited partner of a partnership. A general partner is subject to self-employment taxes on the partner's distributive share, whether or not distributed, of income or loss from any trade or business carried on by his partnership. There are exceptions. In contrast, a limited partner is not subject to self-employment tax, except to the extent a limited partner receives guaranteed payments for services rendered to his partnership. The term limited partner for self-employment tax purposes does not depend on whether the individual partner is denominated as a limited partner under state law. The service in 1997 provided a functional test to determine if a partner is to be deemed a limited partner. A partner, an individual, will be treated as a limited partner unless 1. He, she, it, hereafter all shall be referred as he, has personal liability for the debts or claims against the partnership by reason of being a partner. 2. He has authority to contract on behalf of the partnership under statute or law pursuant to which the partnership is organized. Or 3. He participates in partnership trade or business for more than 500 hours during the taxable year. The 500-hour rule. The 500-hour rule is not a per se rule if the following two prongs are met. First, if immediately after the individual acquiring a partnership interest, the limited partners of the business existing prior to the acquisition had the same type of interest he acquired, and second, that the individual rights and obligations with respect to the specific class of interest are identical to the rights and obligations of the rights and obligations of the specific class of interest held by the existing limited partners. A class of interest is defined as an interest that grants the holder specific rights and obligations. If a holder's rights and obligations differ from an existing limited partner's holder's rights and obligations, then the interest belongs to a separate class of interest. Under the 1997 proposed regulations, a service partner may not be seen as a limited partner. The functional test does not apply. Exception: if the service is a de minimis amount of service. This is not defined by the service. The service will allow individual who is not a service partner in a service partnership and is not treated as a limited partner under the functional test to bifurcate his interest in a partnership between a general partnership and a limited partnership interest. The services use the two-pronged test defined above in the same manner to determine if some of the individual interests may be taxed as a limited partnership. There is no limit as to how small a general partner's interest should be when determining whether the individual is a general partner. The service no longer looks at the limited LLC's continuity of life, limited liability, or the free transferability of interest to tax the partnership's members. Section 1042 of the Code provides different rules. For computing a partner's net earnings from self-employment, it depends whether the partner is a general partner or a limited partner. State distinctions may be important for self-employment tax purposes. A limited partner should not be liable for debts or obligations of the limited partnership, similar to an LLC. An advantage of the LLC is that it will allow the member to participate in the management and control of the company without incurring liability. A limited partner risks that liability shield if he participates in the management and control of the business. A limited liability company is an entity that is afforded rights if incorporating state formalities are met. Okay, that's very important. The limited liability company law will shield its members from liability while affording the members the right to manage the LLC. Depending on state law, the distinction between managing members and non-managing members of an LLC can be relevant for self-employment tax purposes. The limits test for general partner status under self-employment tax is the taxpayer's managerial authority. Managing members of a manager-managed LLC and all of the members of a member-managed LLC should be treated as general partners for self-employment tax purposes. An S-Corporation is a small business corporation. An S-Corporation will offer its owners tax advantages that cannot be achieved by an LLC. One of the most significant tax advantages of subchapter S-Corporation is the ability of an S-Corporation shareholder to reduce its liability to self-employment tax liability. For an individual must pay, in addition to other taxes, a self-employment tax on the individual's self-employment income for the year. The self-employment tax consists of two components. First, or one, old age, survivorship, and disability insurance, OASDI, and two, hospital insurance, HI. The OASDI component of the self-employment tax is computed at a rate of 12.4% of an individual's self-employment income. The HI component of the tax is computed at a rate of 2.9% of an individual's self-employment income. A subchapter S corporation shareholder does not pay self-employment tax on any of the income that flows through the shareholder. Now, if a shareholder performs services for the corporation, then the corporation must pay the shareholder a salary for the work performed, and the salary shall be subject to FICA and FUTA. There will be no self-employment tax liability or FICA or FUTA tax liability to the extent that the S-Corporation shareholder's pro rata share of the corporation's income exceeds a reasonable salary for the shareholder's service. The self-employment tax liability of a member of an LLC may differ depending on whether the member is considered to be a general partner or a limited partner. In general, a member of an LLC who is considered to be a general partner includes net earnings from self-employment of the member's distributed share of the LLC's net business income. On the other hand, if a member of an LLC is considered to be a limited partner, the member includes in net earnings from self-employment only guaranteed payments for the member's services to the LLC. Thank you for taking the time to listen to this presentation. As can be seen, whether or not to choose an S-Corporation or an LLC will depend on whether the member of the LLC shall be a passive or active member, and whether the shareholder of the S-Corporation shall be rendering services for the benefit of the corporation. Again, Ruben Alcoba, thank you very much.